Okay, welcome. This is going to be an e-tutorial on how to solve E6-2 from the workbook. So Elmo's Music carries a large inventory of guitars and other musical instruments. The store uses the FIFO method and a perpetual inventory system, and the company records indicate the following for a particular line of guitars, that sell for $1,600 each. So we're given a list of transactions here, and what I'll do is I'll highlight that in light orange because we're going to be referencing that throughout solving this problem. Required to prepare a perpetual inventory record for the guitars, then determine the amounts Elmo should report for ending inventory and cost of goods sold under the FIFO method. So we know from our discussion last week that inventory costs can fluctuate. They can go up or they can go down. And what that's going to do is impact our journal entries, particularly the one where we debit cost of goods sold and credit inventory to update our inventory balance on the balance sheet. So I'm just going to highlight a couple things important in this question. We know that they use the FIFO method, and that's going to help us solve this problem first in, first out. So whatever inventory they acquire first, we're assuming that they're also selling first. Now we're given a schedule here near the bottom of the screen. In this schedule, there's three broad columns. There's purchases, cost of goods sold, and inventory on hand. Inventory on hand is what we currently have in our storage room or our warehouse right now as of a specific date. So that's going to be our balance sheet value. The cost of goods sold column here is what we're going to use to calculate what the journal entry amount would be in order to calculate cost of goods sold as a debit and then credit inventory. And then purchases, whenever we acquire inventory, they'll be located within the purchases column of the spreadsheet. So on May 1st, we had a balance, we had 5 units at a unit cost of $900. So on May 1st, we're going to populate this in our schedule. We didn't purchase anything, and so there's no real journal entry required. We're just indicating what we currently have. What is our balance sheet value as of this day? So if we had 5 units and the unit cost was $900, our balance sheet value as of May 1st is going to be $4,500. So nothing too particularly difficult in getting us started off here, and we're done now with this May 1st transaction. And to indicate a new day, I'm just going to make this a little clearer for us. I'm going to put a thicker border along the bottom of these cells to indicate a new day. Now it's May 6th, and on May 6th, we made a sale. We sold 3 units. So I know there isn't given a unit cost amount here. I actually don't need to know what the sales amount is in order to solve this problem. The purpose of the schedule down below is to calculate what is the cost of goods sold, not what is our revenue for this sale. Although it does give us the revenue amount up here, each line or each particular guitar sells for $1,600. While it does give us the sales price, I don't need to know the sales price in order to calculate cost of goods sold. I just need to know the quantity and the unit cost. So we sold 3, so I'm going to put that as my quantity. Now the unit cost is first in, first out. Currently, we only have 5 units. And that was kind of a little bit messy. Let me erase that and try again. Currently, we have 5 units. The unit cost of that 5 units is $900. This is what we currently have on hand. So what I'm going to actually do is take that 900 and move it here. We're going to use this 900 in calculating our cost of goods sold. Remembering, this is our cost. This is not the cost to the customer. So the total cost of goods sold for us, or for Elmo's Music, is $2,700. But now we have fewer units. We sold some products, we got rid of it. Our storage room has 3 less units than it used to have. So our inventory on hand as of May 6th is, well, the 5 units we used to have minus the 3 units that we just sold, leaving us with now 2 units. Something to keep in mind with the unit cost on cost of goods sold related problems is that the unit cost of our inventory on hand doesn't change when we make a sale. It only changes on purchases. So there's nothing really to update here. It's going to be the same 900 as the unit cost we had before, and the total inventory on hand is now $1,800. So this $1,800 would be what is reported as a current asset on our balance sheet as of May 6th. Now we're done with May 6th. What I'll do is, to indicate a new day, I'm just going to make a thicker border along the bottom to make it a little bit easier for us to follow. And now it's May 8th. And on May 8th, we made a purchase. We bought 10 units at a unit cost of $840. So that's going to be categorized among the purchases column here. Since we bought 10 units, I'm going to put a quantity of 10. The unit price was $840. So our total purchase price is $8,400. Now I want to know what my total inventory balance is on the balance sheet as of May 8th. Well, before I had 2 units at a unit cost of $900. So of the units I already had, my balance sheet value would be $1,800. But now I just bought 10 additional units. Those 10 units had a unit cost of $840. And now my total of that transaction was $8,400. So as of, what is this, May 8th, as of May 8th, I have the original 2 for a total amount of $1,800. And then I added 10 for a total amount of $8,400. So my balance sheet value as of May 8th is going to be these two added together. It's going to be $10,200. Those two added together. Sorry, I know that's a little bit messy. Bear with me as I adapt to teaching online. And we have a total of 12 units. So what you'll notice with the FIFO method is, for all of the unique unit prices that we have, we're going to have that number of lines within our inventory on hand portion of the perpetual inventory record schedule. So since we have 2 unique unit prices, as of the May 8th date, we're going to have 2 lines, one to reflect each of the unique unit prices. But we're done now. We're done with this May 8th transaction. But just to recap before we move on May 8th, we have a total of 12 units. And our balance sheet value is these two added together, which equals $10,200. It's now May 17th. On May 17th, we made a sale. We sold 4 units. That's going to be over here. We sold 4. I know I'm going to need to put 4 within the quantity of May 17th. Now I have 2 lines to draw from in the previous transaction. As of May 8th, we had 2 units at a unit cost of $900 and 10 units at a unit cost of $840. Under FIFO, we assume that we sell the oldest units first. So since the 2 units were originally part of the original 5 that we had on May 1st, we're going to sell those first. And those 2 units had a unit cost of $900. So this 2 here gets carried forward and becomes the 2 that we're selling. Additionally, So now we've exhausted all of the 2 units that we had at a unit price of 900. Now the other 2 must come from when the unit price was 840. So the other 2 comes from the 10 that we have. And the unit price of those was 840. That means the cost of goods sold on May 17th is 1,800 plus 1,680 for a total of 3,480. That's the total cost of goods sold on the May 17th transaction. Now what I need to do, I also want to know what's my inventory on hand as of May 17th. Well, I had 2 units. There's 2 units here. Let me just highlight so you can follow along with what I'm talking about. I had 2 units here, but then I sold those 2 units. So now I had this 10 here. I sold 2 of those 10. So now I have 8. Unit price was 840, which leaves me with the balance sheet value, a current asset value of inventory of $6,720. Now I'm done. 17th. Now it's May 30th, and we made a purchase. We bought 5 units at a unit price of 840. 5 at a unit price of 840. The total purchase price of this transaction is $4,200. So now what I can do, since this is a purchase that we made, this is of course going to be added into our inventory on hand and become part of our balance sheet inventory balance. So we originally had 8 units plus at a unit price of 840 for a total balance sheet value of 6,720. That was on May 17th. Now we're adding 5 units to that. Since this is the same unit price, I'm able to combine these into a single line. Remembering that if you have unique unit prices, as of every date, there needs to be that number of lines to represent that. But since these unit prices are identical, I can combine them here. So I originally had 8 units, and I bought 5 additional units. The unit price is 840, which gives me an inventory balance on the balance sheet of 10,920. Now we're almost done this problem. This is good. So my inventory balance as of May 30th, remembering inventory is a current asset on the balance sheet, is $10,920. I have 13 units at a unit price of 840. Now, if I look back at this problem, it's also asking me for the ending inventory. The ending inventory and cost of goods sold. So I know my ending inventory is going to be 10,920. Why? Well, because it's on the balance sheet. Balance sheets are a snapshot in time. So as of May 30th, I have 10,920 of a current asset on my balance sheet. Cost of goods sold is a little bit different. Remembering that's an income statement item, so that's an expense on the income statement. So what we have here are individual cost of goods sold. The May 17th, for example, the cost of goods sold was 1,800 plus 1,680. But we also have a cost of goods sold from the May 6th transaction. So our total cost of goods sold for the period is going to be all of these added together. And voila, we've done the problem. Now this is a little bit messy maybe for you to see on your end with all of the markup. So what I'm going to do now is just erase all of these. so you can get a better idea of what a complete product would look like. Now, if you take my class, you know that I like to go a little bit farther than just doing the traditional problem. This is all that was asked of us. Nothing that further was required. All it asked us to do was prepare a report for ending inventory and cost of goods sold. So remember, we have ending inventory here, and cost of goods sold for the period is going to be the individual cost of goods sold, the transactions that happen throughout that period. It's going to be the cumulative total. But remembering when we make a sale of inventory under a perpetual inventory system, we're going to have to do journal entries. There's always going to be two. One to reflect the sale and possibly reflect either cash or an accounts receivable, and the other to actually update our inventory balance. So I'm going to go through just an example journal entry for these transactions. I won't do all of them, but just the first couple. So just give me a minute here to get my template set up. Okay. And again, I'll give us a little bit of a cleaner schedule to work with. So I'm going to start by just focusing on May 6th. So here we made a sale. I know that we made a sale because, well, on May 6th, it said sale, we sold 3 units. So remembering when we're dealing with inventory, we're going to have to do a journal entry, 2 journal entries, 1 to reflect the sale and 2 to reflect and update our balance sheet amount. The question told us at the very beginning, and let me scroll up here, that each guitar sells for $1,600 each. We're going to need that in order to do the journal entry for the first one. And I'm going to make an assumption here. Maybe I'll just type in my assumptions over here so that if you guys are looking at this later and wondering what the heck I'm doing, you know. All sales are on credit. That's my assumption. That means if all sales are on credit, accounts receivable is going to go up. How much is it going to go up by? Well, the unit price or our selling price is $1,600. We sold 3 units. So our accounts receivable is $4,800. The other side of this transaction, of course, is sales revenue. $4,800 to balance out my transaction. But this is only half of it. This is only half of the journal entry. The other half, of course, is to actually do what we calculated on May 6th in this schedule. The purpose of it is to help us calculate what is cost of goods sold. So if I look up at the schedule on May 6th, we calculated the cost of goods sold. And that wasn't really that great. I was hoping to circle it in red. So one more time. The cost of goods sold was $2,700. And that was on May 6th. So that becomes our journal entry amount. Cost of goods sold, $2,700. The offset, of course, is to inventory. We physically got rid of inventory out of either our storage room or our warehouse. So our balance sheet needs to be lowered to reflect items that we no longer have. So we lower inventory by $2,700. And again, you know that I always challenge you to think of beyond just the question. So looking at this transaction, I'm going to ask you now, well, what's gross profit? What's the gross margin on this transaction? Remembering that we know gross profit equals net sales minus cost of goods sold. I can look at this May 6th transaction and I can say, well, gross profit on May 6th, that's going to be my sales revenue minus cost of goods sold. So gross profit on the May 6th transaction is $2,100. And that's as far, I think, as I'll go with this problem. Let me just clean up the question one more time to make sure we have a clean schedule to share with you guys. And there we go. Thank you for listening. This is Kyle. See you later.